Hello, and welcome to the Wade Borth Podcast. I'm your host, Wade Borth, and in every episode, my goal is to get you to think differently about how money works and ultimately to empower you to take control of your money and your personal financing system.
Now, he gets into the chapter a little bit too, where he talks about this 30-year-old man who's in the logging business, and he talks about the numbers. And I would just encourage you to read this chapter. If you want to take a look at the numbers, take a look at the illustration. That's hard to get across on a podcast. So we're going to keep it kind of at a high level from the basis of just the thought process about what we're thinking about, what Nelson was trying to say in this chapter. And you can go back and look at the numbers. I encourage you to read all the chapters that we've talked about in the past and just use this podcast as a way to kind of say, oh, I see what he's saying, or maybe it's more thought-provoking than anything, so you can kind of dig deeper into these chapters as well. But so it's hard to get across the numbers. So we're not necessarily going to reference back to all the numbers on this thing, but we need to understand that he was financing equipment. He was already doing that with somebody else. He's getting it. Like, he was paying him to buy this equipment, and he was putting a down payment. He was financing it with somebody else. And, he did that a couple of times, and he goes, okay, how can I make this better? And so one of the things Nelson does is that he says, if we're going to do, if we have a policy and we just do just the policy by itself, here's the baseline, and this is what we could get for retirement income. And so Nelson was never a big fan of retirement, but in this situation, he talks about a retirement income, a passive income stream of money from this base policy. And that's kind of what he talks about on page 51 is here's this passive stream of income. Then he says, well, how can we make this better? And so he makes it better, and we'll get into a little bit more of that. He makes it better by saying we're going to use it as a financing system up into that point where we want to start taking passive income from it. You and I have talked about this in the past, is that retirement is sometime in the future, this event that's going to happen at age 65, 70, 75, or never, whatever it might be. Passive income stream is going to happen sometime in the future. So what are we doing between today and that point in the future? And we have this pool of money. But what can we do with that pool of money between now and that point in the future is now we can start enhancing and using it on a daily basis.
Right.
I had to read this, and I've read this a number of times, and as I was preparing for this, it just really dawned on me that it was about setting out a baseline. Here's the baseline of what the passive income could be if we did nothing. There's nothing else besides put our money there. And, he talks about, how you take distribution. And I was talking with a client here a while back. He's like, oh, Nelson talks about taking distributions out of the policy for retirement. And there are certain advantages to doing that because you can pull them out on a tax-free basis up into the point of all your premiums you put into it. And then any dividend surrender after that may be taxable or it may not be taxable. This is an opportunity for you to choose how you want to go about that. Mm-hmm. Nelson never really gets into that because, again, he was never a big fan of the idea of retirement income. He was just trying to drive home a point that there was a certain dollar amount that you could have, and how can you make it 3, 4, 5, 10 times higher by applying the banking function? It's because you're going to have more dollars flowing back to your policies and to your system if you control that banking function for yourself and all the other people that want to take advantage of it.
Yeah. And Wade, I think that's part of just Nelson's entire philosophy of control your own money from beginning to end. Set up the banking system and control it from beginning to end. If you want to have other people, then it's your choice.
Right. Exactly right. First, you control what you can control and how it affects you. And then you can invite people into your business and do business with people that you want to do business with. You're not forced to do it, but you can invite people or they can offer and you can accept. You don't have to, right? So it's all about who's in control. And there was a CPA told me this one time, and I think maybe I've mentioned this in a previous podcast. I know I've shared it with you. He always made the comment that whoever controls the financing always wins. Whoever controls the financing always wins. And I thought that's such a powerful statement because you might be financing a guy to do a deal, and is he going to have a successful business? He might make a decent living, but you're always going to win. And he made this point in this chapter many times that the logger makes also a living in his life, but the bank gets very wealthy by doing this.
Well, I think too, as we're sort of talking through this, and I kind of alluded to this earlier, but as I'm thinking about this concept of equipment financing, and if you don't put this into the context that this is a long-term, lifelong process, It's not a transaction of I'm buying a truck or 2 trucks or 10 trucks or whatever. It is a process of I'm capitalizing this business. I'm going to have to borrow this money from somebody. Why wouldn't I borrow it from myself? But you have to put it in the context of I've capitalized this. I've spent the time to grow this to a point where I can borrow it. If you come into this saying, I just bought this policy and I need to put 40,000 in so I can take 40,000 out, that doesn't make any sense at all. It doesn't make any sense from a long-term perspective. If I'm capitalizing it anyway, and this isn't the only transaction I'm going to use, it makes a lot more sense.
Right, because again, you're going to finance something. Your need for cash and money is going to be there the rest of your life, no matter how old you get, right?
Right.
And again, if we go back to the premise that we finance everything we do, even if we pay cash, we finance everything we do, then the question is, why do we want to have a system that can absorb that? And he talks a little bit about that. So on right-hand side of page 51, he was giving a very specific example of taking out, if you pay annual premium of $15,000, and he gives that whole example up there in that first paragraph on that side of the page. It was because he was just trying to isolate a closed system. He was just like, here's a closed system and here's how it works, just so it would help us. But later on, he talks about how can I make this much bigger and much better, right? He says, why can't I finance 2 trucks? Why can't I finance 3 trucks or whatever it might be? And again, we have to be careful not to get out ahead of ourselves because we have to build systems. We have to build a banking system, not just one policy. It's a series of them over a lifetime as we need them, as we grow with them. And it is a long-term process, and you have to be a long-term thinker, and you have to engage in this process for the rest of your life. And if you don't want to do that, if you want to abdicate that to somebody else, then continue being controlled by Wells Fargo, continue to be controlled by Chase. That's fine. This might not be for you. It's just those that want to control the function and be in control, which leads to, the freedom of money, time, relationship, and purpose. Then this is the system for you. And it's not difficult. It's very simple. It's a very simple idea, right? I'm going to control the system. I'm going to do exactly what the banks do, and then I'm going to reap the rewards. But the rewards don't happen overnight. It's just like in the other business. It's not an instantaneous. He said that at the very beginning, in the very introduction to this book. He said that is that this is not a get-rich-quick scheme. Quite to the contrary. It is get richer over a long period of time. So it's not something that is for the faint of heart or for those that are willing to put 1 or 2 years into it. You have to understand it, get behind it, just like owning any other business. And once the business is up and running and you have a system designed for it, man, it becomes, just speaking from experience, doing it for 15 years, the longer you're into it, the better the system becomes, the more understanding you get. And I guess maybe that's why I like this chapter, this equipment financing chapter, because it gives examples of how to put it together, right? It shows the lease agreement.
Yeah. I think too, it was my natural to say, maybe there's a way to circumvent the time that it takes. And when I think about, there's no way to circumvent a bank. You're going to go to a bank and you're going to follow the call and their rules, and you're going to do whatever you have to do at the bank. There's no way to circumvent this either. So it isn't a sleight of hand or a magic trick. Again, I'm going to say of putting 40,000 in and 10,000 out. If I put $40,000 in, how can I get $40,000 out immediately to finance this equipment? Then you're limiting what the real value of this system is.
Yeah, a good point. It's because then, and when I run the numbers and just today's numbers, I can make the point that, hey, if you want to do a comparison of cash doing the banking process, which again is the process of understanding how money flows and how you have to charge for it, versus cash. And we go back to the previous chapters. We could talk about the CD system. We could talk about somebody using a CD or financing using a CD as collateral, or the life insurance policy. I can show you where, in the short term, 6 or 7 years, you're better off doing a CD. You're using a CD as an example to do your financing with. But again, who's in control to give you the loan? It's the company. It's the bank that holds your CD, right?
Right.
So it's not really about interest. It's not about really anything else more so than it is about control. Because in this chapter, he talks about you're going to take a loan from the insurance company, and they have to loan the money somewhere, and you just happen to be, and this actually gets on to page 52, they have to borrow the money to somebody to make an interest on it. And so you happen to be just first in line. You get the first right of refusal to go borrow money from the insurance company. It's in your contract. It's by contract law. that you can go and borrow up to the equity that you have in your policy.
Yeah.
So they don't have the ability to tell you, no, we're not going to give you a loan unless you don't have the money in your policy to borrow against. But the point is build up enough capital so you can borrow against it.
Yeah.
And the easiest way I can explain it to people, and I think they get it, is it's kind of like having a HELOC in your house, right? You have equity in your house. You don't take the kitchen sink from your house to go buy, tractor tires or whatever it might be, right?
Right.
Go to the bank and you say, hey, bank, would you borrow me money against equity in my house? Because I'm going to go and I'm going to make an investment. And they get a thumbs up, a thumbs down, and then you get access to that money. But they can call the loan. They can shut off that line of credit. We've talked about that in the past too.
Yeah.
That's happened in the past where you think you have a line of credit, a HELOC line of credit, and you're going to go do some great investing when times get tough. The banks will shut you off as quickly as they turn it on. They have the authority to do that. And they've done it in the past. 08, 09 tells us they've done it. I hear just a couple of years ago, Wells Fargo was sending letters out to anybody that had a line of credit that, that's going to be shut down. And they got such flack for it that, they decided to reverse that position. But they have the ability and right to do it. When you have your money with in a properly structured life insurance policy with a mutual insurance company, they cannot deny you if you have equity. They're the ones that, you come in and you say, hey, I want a loan. You're by contract. Again, I can't stress this enough. By contract, you have the first right to access to that money.
So I was kind of thinking when you were talking about a line of credit from the bank, a line of credit means they're giving you credit for something, just like a credit card. But just like a credit lower your, company can lower and pull it. They can demand full payment. It's their money, not yours. You're just borrowing it.
You're playing on their football field and playing by their rules. They can change the rules whenever they want. So the question is, do you want to play on that field or would you rather play on your home field?
Yeah.
How valuable of a situation is that, right? You can play on your home field. You play by your rule, and you might invite them to come to you and use their services, but you don't have to. Quite frankly, this is the way for you to completely get away from that function.
Yeah.
And here's a funny thing, as we read the bottom of page 51, Nelson talks about, if you need $16,000 or he's paying $16,000 per month of that pool of money, equipment to use in the logging business, all the financing company did was go to the insurance company, because you look at a lot of things that are like leasing companies. Where do they get their money from? Insurance companies, right? So they go to the insurance company and say, hey, we'll buy up this big block of business. You give us a rate. They take that rate. They turn around. They go buy a piece of equipment. They lease it back to you, and they're getting profit off of it. They're getting a significant amount of profit for doing that, right? So the question is, if they're going to the insurance company where you have your money, why do you need that middleman? Do you need that middleman for the paperwork they do? That might be the case. It's very expensive paperwork. When we can, I've shown clients how to do a loan document and an amortization schedule. It takes about 20 minutes. Is it worth the thousands and thousands of dollars that you're giving up in interest to somebody else to do those things for you?
Yeah, they're borrowing your money to loan it back to you.
Yeah, and making a profit off of it. And you're the one that eventually has to, remember, we talked about who the players in the game are, right? Who the players and who the actors are in the play. Nothing happens without somebody that's going to borrow money. So if you're that person borrowing money from that institution, you pay for all the other things that are going on. You pay for the hired help, you pay for the management, you pay for the profit, you pay for the guy that's depositing it. So the question is, why do you want to play that game? Why not just eliminate that middleman and go directly to the same source that they're going to?
And I think that, so I've had people that if you are a person with good credit, this is never an issue. It should never be a problem. And it may never be a problem. It's my money. I work for it.
Right. People have good credit. So let me ask you that. So if you don't plan for this, if you don't have your own system set up, so let me back up. Am I saying not to use the regular banking system? Am I telling you not to use Chase? Am I telling you not to use Wells Fargo or, Bank of America, whoever? I'm not saying don't do that. Quite frankly, I'll say, hey, use them if you think that's what you want to do. But what if they tell you no? What if, and actually we'll address it in a later chapter, when we talk about cost of acquisition, what if they're too slow for you to move, right? You might have great credit, but banks move at banks' pace. They move at, again, you're on their playing field.
Right.
They make up the rules. They tell you that they need these 40 forms signed and they're going to need this documentation. And when you get them all the things that they ever ask for, then they always come back with one more pint of blood that they need. And so what is that saying as far as how much control do you want to have, right? Do you want to play on their field or do you want to be playing on your own field? And then again, if you have great credit, who's still making money at the end of the day? Who's making that profit? Banks seem to always make money, right? I shouldn't say they always make money. They always make money, right? They seem to go broke and need bailouts, but these are institutions because I think they're fraught with mismanagement and some real deceit going on there. But the point being is that they always make money off you, right? They control the financing function in your life, and they have the ability to give you thumbs up or thumbs down, even if you have great credit. People with great credit had their line of credit shut off in 2008, 2009. No matter what anybody thinks, that happened. And if you disagree, give me a call and I'll tell you the story of what happened to our family. Because this is what really drove home the point about this. I was teaching this, I was doing this, but I don't know, I was probably 80% in, I wasn't 100% in. And then we were going to finance a remodel, and the day we wanted to refinance or refinance the addition to our house, we got a letter saying our line of credit had been pulled. I'm like, wow, and we had great credit, great jobs, everything was great, but they had the ability. And I'm like, there's the driving factor of why I want to be in control. Now, again, if you have a bank chasing you down, you have a credit union say, I'll give you an auto loan for 2%, you might want to take advantage of it. I'm not saying don't, unless it's philosophically you want to get rid of the Fed and you don't want to participate in the system. But from a numbers standpoint, yeah, go ahead and do it. It makes sense. Cost of capital, your access to capital, go there and get your money. But then apply the banking system and pay back what they're asking for, plus an additional, because you have some lost opportunity money, which you could have done with that had you not bought that car or whatever it might be.
Yep.
Not saying don't do that. I'm just saying, why wouldn't you want to have a secondary system? Again, controlling it and then having the profits flow back to you over the long run. And again, if you want to use other sources when times are right, then go ahead and use other sources. It's not the end of the world. But when you only have one place to go, that's not a choice.
Yeah. People say all the time that all their eggs in one basket, and yet they're financing it somebody else's.
Yeah, exactly. And so who wins? People have control of financing, those win. So we go in the middle of page 52, it kind of addresses that point, because up there in the first full paragraphs, he's talking about buying the truck at this time. Instead of buying it to the finance company that got their money from the insurance company, he says, I'm going to call the insurance company. And Nelson calls them Gophers at the insurance company and says, hey, I want to borrow $52,000 from my policy to finance a truck. And he says, look at this illustration. And again, he says, the life insurance company must lend to somebody in order to make the plan of insurance work. So why not borrow it to you? Again, you're the first in line to say that. But this is the point that I think is really key here. He says, pay close attention to this point. It is vital. He uses vital that you understand that you must set up a loan repayment plan that equals or exceeds what you would have paid the financing company that was that you were using in the first place. So let me just reread that because this is so important. It is vital that you understand that you must set up a loan repayment plan that equals or exceeds what you would have paid the financing company that you were using in the first place. And I know people that listen to my podcast have heard me say this. You've heard me say it, so it almost feels like it's redundant. But what am I going to say, Nicole?
This all goes back to the stealing the peas. And he says down in that next paragraph what the response from this young man would be. I'm not going to pay any interest at all. It's my money. So right there, we have to again come back to this and go, yeah, it's your money. Why do you care? Why do you love Wells Fargo more than you love yourself and your family? You're going to pay them interest, but you're not going to pay yourself anything. Why?
And that's all about conditioned thinking, right?
Yes, it is.
To think that. It's like, because again, they don't understand. Most people don't understand or don't know or choose not to know that they're in the financing business. If they understood that this is the most valuable business in the world, the greatest business in the world, which is the banking business. And again, we use the word banking loosely. It's a process of exchange of money. But if they're in that banking business, then this is the greatest business in the world. Why do you want to steal from yourself? And he makes the point. He says, if that person if he's going to go back and read, it talks about the National Bank of Midland, Texas, and he doesn't understand it or chooses not to understand it. He makes the point here. He says, if this person reads this and doesn't get this, because again, we want to give people grace and understanding that, hey, this is where you're at now. We're trying to educate you, but if you're unable to get that, then either you're unteachable or you're a thief. And Nelson always says, I don't want to work with you because you're business partners. If you do business with me or somebody does business with you, Nicole, those are your business partners. So do you want to be doing business with people that have those characteristics? You're willing to pay somebody else, and that final paragraph on 52. He says, you're willing to pay somebody else $1,600 per month. Why aren't you willing to do this for yourself?
Yeah.
The very last sentence of that page, I think, is another real key. He says, the extra money does not go to the general portfolio of the company. It goes to the policy that is being administered by the company on your behalf. I think there's a real big misconception of how this works. If I have to borrow from the insurance company at say 5% today or 4%, whatever it is, let's say 5 just for easy math. And I was going to have to be paying somebody else a lease at say 15% for a piece of equipment or office equipment or, computers or whatever it is. Those lease rates are up there. They don't have to put a percentage rate on those things, but equipment financing for logging is one way. But think about this from a business standpoint. I have to upgrade all my computer systems in my office. It could cost me thousands and thousands of dollars, right? Either you have a choice to buy it or you have a choice to lease it. If you lease that, which is sometimes the best to do because of the depreciation of the equipment. So you say, I'm going to lease that. If you did the math, sometimes that lease payment could be anywhere in the neck of 15 to 18%. Again, because it's a lease, they don't tell you what the percentage rate is that you're paying because they don't have to. But just do the simple math. Nelson used the comment about, it's third grade math, be able to figure this out, right? And so the point being is that if you do it, it's 15% just for simple math. So I'm borrowing at 8 or 5. Nelson used 8, but say in today's environment, we're borrowing at 5. And I was willing to pay some other lease company 15%. Why wouldn't I pay it back at that same amount, right? That's the question.
Right.
If you agree, yes, I'll pay it back at the same amount, that money doesn't go back to the general fund of the insurance company. It goes back to your policy in the form of premiums, additional premiums going back to your policy. And it takes me back to a point I think that's been a lot of conversation around how policies grow, because it seems like there's this mythical, I pay interest back to myself. You don't pay interest back to yourself. You pay interest to the insurance company. The insurance company uses that in their general fund to run operations, and then after it's all said and done, when they figure out mortality and expenses and claims paid, which is mortality, then they return to you the form of interest and dividends. So it's not a direct growth of your policy. Where you can see the direct growth of your policy is if it cost me 5 to get, I'm charging my business 15% because that's what somebody else was going to charge. That extra interest comes back to my segregated account. So again, I set up a segregated account. I just call it the Borth Family Bank. And then at the end of the year, I'll say, okay, our expenses were 5%. Our income, we had at 15% for the use of that money. So we have extra money in that account. And then we take that extra money and we redirect it back into our policies in the form of additional premium. So let's make this statement real clear. The only way that policies can grow are dividends, interest, and premium. Interest from the company, dividends from the company, and extra premium. So the premium that's again, I think I've heard a lot of people say we capture lost interest. I don't necessarily recapture lost interest. I don't necessarily like that because, again, you're paying for it. Somebody's paying for it. And then that extra interest, that profit, as it were, again, if I'm paying 5 and I'm charging 15, there's a difference there. That goes back to our policy in the form of extra premium. And that's how you're going to grow your warehouse. That's how you're going to grow your inventory, is by having profit from the use, putting the money to work. Does that make sense?
It does make sense. And if, in your example, if you are paying 5 and you would have been paying 15, I think that's what you said, that 10%, people will often say, I'm going to save that interest. I'm going to pay that interest. I'm going to save it. But where are they saving it? They're not saving it. It's being redirected and spent in their place. If they're really saving it, they can save it into this policy and do the exact same thing over and over again.
Right. When they were going to work with the leasing company, that was going to go back to the leasing company. Now that's coming back to you, but now you want to be an honest banker because you said, I'm in business. I want to be profitable. So again, my wholesale cost is 5. My retail cost is 15 because that's what the rest of the market is demanding. And I take that difference and I put it back to my policy because all I'm trying to do is grow more inventory. I'm trying to put more peas on the shelf.
Yeah.
But I think there's some real confusion around that interest. I hear it all the time. I'm paying myself interest. No, yeah, you are. But when it goes from, your segregated account back to the insurance company, they just lent you money so that you're using their money for 5% interest. And that extra interest goes back in the form of premium. And I think Nelson makes a point to that on page 58. He says, actually, this interest is not really interest, it's just additional premium or capital that's been paid into the policy that equals the interest that would have been paid somewhere else.
So in the current low interest rate environment that we're in, when you have somebody that says, okay, but I can get a car for 0% or 1% interest or whatever that is, and now you're telling me that I should be paying 8% interest.
So part of that is if you want to go to the credit union and get it for 2% interest, it's a car. I'm saying, it's all about what the cost of capital is at the time. Insurance companies charging 5, credit unions charging 2. Take advantage of the credit union, go ahead and do that. But again, that $50,000 that you finance the car, that payment that you're making, what could you have earned on that had you not bought that car? What's your lost opportunity cost? So use the credit union to finance it at 2, but run another amortization schedule. Says maybe I'll run it at 8 as a payback, and you take the difference and you put that back into your segregated account, right? Your separate account, your separate checking account, because you maybe could have earned 8 on that money had you not bought the car, right? So again, it's about economic value added. We've talked about that in the past. It's this idea that when we put money to work, buying a car, what's the true cost isn't just the interest that went to somebody else, to the credit union, also what we could have earned with that money had never made that purchase.
Yeah.
So all we're trying to recognize is that cost.
Yeah.
Now, so I think that's the first step. And then the next step would be, I can make an argument that if all you're going to do is use the credit unions or the banks, can they move as quickly as you need to move? And we have stories, we have real life situations around that as well. But it is the low interest rate environment's created an anomaly. But at the end of the day, Nelson made the comment. He says, it's like going over to Kroger to buy your groceries when you own your own grocery store. Why would you want to do that?
Yeah.
I mean, you can buy a little bit cheaper. But if you are going to buy it cheaper, at least put back in your business, which you would have charged anyhow. And that's just being honest and fair with your banking business or your finances.
Yeah. It goes back to that little phrase, the honest banker. And I think that's really important, that we have to remember that we're either being honest or we're stealing the peas.
Later on, and actually on page 53, Nelson talks about the growth in this policy. So now he goes back to that baseline that he was talking about on page 51, what the minimum amount that you could have in retirement income or passive. And on page 53, he gives the example of here it could be better. And the reason why it's better is just because you put more premium into your policies. It's not because there's some phenomena with doing this loan or from the insurance company. It's just the fact that you put more money into your policy. So now you have more passive income. Again, what you kind of did is you took away from the bank's passive income in the future and put it in your own, on your side of the ledger. That's really all you're doing. It's like all these things, all these transactions that they've been doing for you, and they're going to get passive income in the future. Now you're going to get that passive income. You're going to get that growth. You're going to get that money. Again, applying the same principles that the bank was doing to you in the past.
Right.
Again, the insurance company, it says right here, says that the life insurance company had nothing to do with this increased passive income. Against the second paragraph on page 53, it was just the fact that you put more money into your policy. That's what it was growing. But again, all that more money is just interest you would have paid to somebody else. And so we're recognizing it and we're putting that back into our system. And then he starts talking about, he's trying to do too much financing. So we have to realize that just like any other bank, we have to have a certain amount of what I call what if capital. Don't, because you have $100,000 to use, don't use $100,000.
Right.
A good friend of mine, Don Blanton, used to always say, you have so much collateral capacity. That's the word he used. And he would say, don't use it all, right? He said, keep it 50% until your pool of capital gets big enough. Have 50% of that money set aside just in case. I kind of buy into that. I believe in that, right? If I have $100,000 to use immediately, do I want to use $100,000? Maybe not. Maybe I'll use half of that until my pool of money gets so big that maybe I get it down to using, keeping 10% or 20% reserves, because those are the reserves that are going to allow you to take advantage of some chaos or keep you out of trouble.
Yeah. The cool thing about that is, though, so if you have 100,000 and you decide to use 50%, so only 50,000, as you're paying that down, that money becomes available to you again. So where you're making the payment to the bank for your car, you write the check for $500, that money's gone out of your account. You've written the check. Now you write the check to the bank of Nicole Tate or Wade Borth, and that money's back in your account again.
Right. Great point. This is where, again, it's very similar to a line of credit, right? I pay back $1 back, and now I have $1 more I can use. So it's not like it's lost and gone. It's just, it's paid back, and now we can go put it to work again if there's enough capital, another opportunity. And you don't have to pay it, you don't have to completely pay it off before you start another one.
I was going to say that. So that was a misunderstanding that I had early on, was that, okay, so you can take these loans out, you have to completely pay them off before you can do anything else. We still have to be judicious about what we're doing, but that is not the case. Once the money is in there, it's your money to use.
Right. And again, comes the idea of, time, money, and discipline. Now we have to have the discipline to say, just because I can do something, should I, right?
Should I?
I have to be honest with myself and say, should I be doing this? Would I give myself this line of credit? So you have to be an honest banker in that sense too, in the fact that you got to call yourself out and say, hey, you can a little overextend it, right? Step back a little bit and get these other ones paid off first. Because there's no magic in the number of loans. There's no magic in the amount of loans. Well, there kind of is in the amount of loans. But don't do a loan just to do a loan. Make it so it's growing well. And doing it the smart way versus just doing it. Because there's no magic in just the loan itself. Having the ability to do the loan has more impact than just doing a loan itself.
Yep.
And then this is where Nelson, at the top of page 53, starts talking about, this is why you're going to have multiple policies over a lifetime. As you grow your capacity, as you grow the need to warehouse additional dollars, you're going to have some additional need for future policies. And then eventually, don't try to finance all your equipment too fast in this equipment financing chapter. He says, don't try to do it all at once. Build it slowly, because again, it took him 13 years to get out of the grasp of the snakes and dragons, as they call them, right? Yeah. So it's a process over a lifetime, but you don't want to do it too fast. You don't want to overextend yourself, and you want to build future policies and systems over a lifetime.
If you're enjoying this podcast or know anyone else that might be interested, please be sure to hit the subscribe button and please leave a review. This will help this podcast reach and help more people by ranking higher in searches, and ultimately help more people get out of financial bondage. And don't be afraid to share this podcast with your friends and family, as we can be easily found on Apple Podcasts and Spotify.